Welcome back to Basic Commencers. My name is Ralph, and in this channel, we talk about finances, the stock market, how to invest, the state of the economy, business strategies. So, I'll encourage you to go ahead and subscribe to this channel and hit the notification bell because you are guaranteed to find valuable content here that can help you in your financial understanding. So, without further ado, let's get into this video. If you've been trading for a while, or if you're just starting trading this, you might have heard a term shorting a stock. So what does that mean exactly? So what does that mean for you? So shorting a stock and the broad sense of it is just a way for you to make money in the stock market. So basically you could see that there are two ways. You can be longing a stock or you can short it. So longing a stock is what you would usually do. You would buy a stock low and hoping that the price goes high and then you can sell it there. Shorting a stock is just exactly the opposite. In this video, I'm going to go ahead and show you exactly how that works and how you can take profit from this strategy. So without further ado, let's get into it. If we are talking about stock, the first thing you have to understand is how does a price or how does the price of the stock behave. If you are looking at a stock, usually what you would see is the price of a particular stock could start. I'm just gonna make it picture perfect just for the sake of explaining. On green, and then at a certain point going forward, you know, for some reason, whatever that might be, you can have a doji here at the top. I have a video on the doji. I'm gonna put it in the description below. Card. If you don't know what it is, you can just click on the link and you can have more information about the doji and you can use it to make money in the stock market. So following that, you could have the prices going down. So with that picture, so what happened? So for 4 days, the price went up. On the fifth day, maybe the the uptrend lost its momentum, and and because of that, the price started going down. So this is how the price would move. You would within the as the price of the stock moves, you have different movement. It will go up, it will go down, and then it will go up again. So then the question is, how can you use that information to make money? Well, if you are a trader, either a swing trader or a day trader, you have the opportunity to buy low and then sell it at a high point. And this is what most people would do. They would buy the stock at a low price and then they would go ahead, depending on the strategy, they would wait and then see everything that they can do and then to sell at a high price. Now, if you make your due diligence, you can also develop a strategy where you can predict or at least have an hypothesis of the point of where the price might be starting to go down. Then, if you have that information beforehand, then the question becomes, how do you use that information to make money? So this is where shorting the stock comes in. So then you would say something along the lines of, well, after that doji, this usually is a signal of a trend reversal. So consequently, after you see that red candle here, then if you are shorting, you would place an order here and then just cover at the bottom. And that essentially is what shorting the stock here is. Shorting the stock is just simply you placing a bet saying that, giving the information that you have, your research, the price movement, the market condition, and your prediction, the price will go down. So what would that look like if we were to trade the stock? So let's take an example. So if you are longing a stock, such as this one, right? So you could say, I'm gonna buy 100 shares, and then from this point there, it move it move for $5. So when you do that, $5 a share with 500 shares, if you got executed properly, you should have made a gain of $500. So now what does that look like if you are shorting? So if you are shorting the stock, what ends up happening is you had your hypothesis, right? So you said that you had predicted how the price is going to go up and you took your profit. Then you want to take advantage of the price going down. So what does that look like? At this point, two things end up happening. So here, the price goes down. So if you predicted it right and your move was correct, if you shorted 100 shares at $5 a share, you end up making $500. If you traded it both ways, then your gain just doubled. Rather than making 500 on this side, and 500 on that side, the combined value of them both gives you $1,000. So shorting a stock, when used properly and effectively, gives you the opportunity to double your profit or to increase your profit margin. But there are also risks associated with it, and this is why you should be always careful when you are shorting a stock. The next question might be, where exactly would you be getting that stock? Usually, if you are shorting a stock, this is something that you do with your broker, and this is something that is usually done through what they call a margin account. It varies by brokers, so you should definitely contact yours to know exactly their specifications, because essentially what you are doing when you're shorting is you are borrowing that stock from the broker, and then you are selling it. You are selling it at a high price, and then after you've sold it, you are buying it back at a low price, and then you give it to the broker so they can give it to whoever owned it first, and then you keep the difference for $3 sign, and then you get to keep the difference. So what does that process look like? If you need me to go further into this, um, let's say you have stock X, Y, and Z that is currently trading at $30. But you predict that with the price action that's been going up for months, it is you now, depending on your indicators and your research, for that price to go down. So what do you say? You go to your broker, and then you say, I want to um, I predict that the price is going down. Therefore, I'm going to need to borrow from you 100 shares to short, so I can sell them now and take the money, and then so I don't lose on that opportunity. And when the price goes down, I will give it back to you. So then your broker then goes and looks through its list of account holders, and decides, okay, I can see that from my list of account holders I have I have a pool of 1,000 shares available to short. I'm sorry, not the dollar sign here. These are shares. I have 1,000 shares available to short, right? So since you need 100, I can easily give you 100. So then they have 900 left to short. So if your strategy starts going really well, you can say, oh, since you have 900 left, give me 100 more. And they do that. And then they still have 800 left to short. So if somebody else wants to come in, they can come in and then borrow from those 800. So from this point on, what's happening? All right. So you have 100 shares of XYZ that's shooting at $30, right? So 100 times $30. So this gives you $3,000. Now you predict that this price is due to go down. So what you end up doing then is you hold it until the price action goes down, like you predict that it will do. So then you short here, and then you buy at this point. So let's imagine that the difference between these 2 points is $10. So then you have 100 minus 20, which is the $30 minus the $10 difference in the price. So the stock XYZ now is trading at $20. So with that, that stock now is worth $2,000, which gives you, which is where you bought it back. Let me write it here. You sold it here, and you buy it at this point. So it then gives you a difference of $1,000. So once you buy that stock back, those 100 shares that you buy back go back to your broker, to those 900, and then it reverts back to the 1,000 overall that they had. And this is how the shorting process work. The brokers get that $1,000 back, and then you get to pocket $1,000 profit, because you are the fortitude to predict what the price action would be.